Imagine standing at the edge of a mountain trail. On one side, you can see a narrow path leading toward an extraordinary future. More freedom, more choices, more security for your family. On the other side, there is a comfortable place to stand still. It feels safe. It feels familiar. Nothing changes. Nothing seems dangerous. Now here's the question. Which option do you think most people choose? If your answer is the safe one, you're right. But here's what almost nobody realizes. Standing still isn't actually safe. It's expensive. In fact, for millions of people, the decision to avoid losing a little money today quietly becomes the reason they never build real wealth tomorrow. The tragedy isn't that they made terrible investments. The tragedy is that they never gave their money the opportunity to grow at all. Every year they tell themselves the same story. I'll invest next year. I'll wait until the market feels safer. I'll start after the next election. I'll begin once inflation comes down. I'll wait until interest rates change. I'll wait until I know more. Years pass. Markets change. Technology changes. Entire industries are born. Fortunes are created. And they're still waiting. The biggest financial mistake isn't always making the wrong investment. Sometimes, it's making no investment at all. Welcome to Wealth Hike. Today we're going to uncover one of the most powerful psychological forces controlling your financial future. A force so deeply wired into the human brain that even highly educated people struggle to overcome it. It's called loss aversion. And unless you understand how it quietly influences your decisions every single day, it may continue costing you far more than any market correction ever could. This isn't about gambling. This isn't about chasing quick riches. And this certainly isn't about taking reckless risks. It's about understanding why our minds often confuse comfort with safety, and why that confusion quietly limits our financial future. By the end of this video, you'll begin seeing money differently. You'll understand why avoiding every loss can actually create the biggest losses of all. And more importantly, you'll discover how successful long-term investors learn to think differently when everyone else is frozen by fear. Because wealth isn't built by predicting every market move. It's built by consistently making rational decisions while emotions try to convince you otherwise. So stay with me until the end, because one simple shift in perspective could permanently change the way you think about investing, opportunity, and financial freedom. Let's go back thousands of years. Long before stock markets, before retirement accounts, before online investing, before money even existed, our ancestors lived in a world where survival depended on avoiding loss. Losing food meant starvation. Losing shelter meant exposure. Losing your tribe often meant death. Our brains evolved under incredibly harsh conditions. From an evolutionary perspective, avoiding danger was far more important than chasing opportunity. Missing one potential reward usually wasn't fatal, but one serious mistake could end everything. That survival system is still inside us today. The world has changed dramatically. Our biology hasn't. Modern neuroscience and behavioral economics consistently show that people generally experience the emotional pain of losing money more intensely than the satisfaction of gaining the same amount. Lose $100. It hurts. Gain $100. It feels good, but usually not nearly as powerful. The brain naturally gives more weight to potential losses than equivalent gains. This isn't weakness. It's human nature. Unfortunately, the financial world no longer rewards ancient survival instincts the way it once did. The modern economy rewards disciplined ownership, patient investing, long-term thinking, calculated decision-making. But our brains continue whispering something entirely different. Don't lose. Protect what you have. Wait until everything feels certain. There's only one problem. Financial certainty almost never arrives. Think about how often headlines create fear. Economic slowdown, inflation, interest rates, political uncertainty, global conflicts, artificial intelligence, market volatility. Every generation believes they're living through uniquely uncertain times. Yet history repeatedly shows that uncertainty has always existed. Markets have climbed through wars, through recessions, through technological revolutions, through political transitions, through financial crises. The environment changes. Human innovation continues. Businesses adapt. Entire new industries emerge. Progress rarely moves in a perfectly straight line, but over long periods, productive economies have historically continued creating value despite temporary setbacks. The challenge isn't the existence of fear. The challenge is allowing fear to become your permanent financial strategy. Because fear feels responsible. Fear feels intelligent. Fear feels cautious. Sometimes fear is absolutely necessary. But when fear prevents thoughtful action year after year, it quietly transforms from protection into limitation. Let's consider two people. Both earn similar incomes. Both save consistently. Both care deeply about financial security. The first person believes safety means keeping nearly all their money in places where the balance rarely changes. Every month they feel comfortable. Nothing dramatic happens. No major swings. No uncomfortable headlines affecting their account. Emotionally, it feels safe. The second person also values safety, but they define it differently. Instead of asking, "How do I avoid every decline?" this, "How do I build purchasing power over the next 20 years?" That single question changes everything. Because money has two jobs. The first job is preserving value. The second, and often more important, job is growing enough to outpace rising living costs over time. When inflation gradually increases prices, money that never grows can quietly lose purchasing power, even if the account balance stays the same. That's one of the most overlooked risks in personal finance. Many people focus entirely on protecting the number they see in their bank account. Very few focus on protecting what that number can actually buy years from now. And those are two completely different things. Imagine placing ice in a warm room. You return later. The ice hasn't exploded. Nothing dramatic happened. It simply melted, slowly, quietly, almost invisibly. Cash can experience something similar, not because dollars disappear, but because purchasing power changes over time. The balance may look identical. Its real-world buying power may not. This is where loss aversion becomes especially dangerous. Because our brains celebrate visible stability, while often ignoring invisible decline. No flashing warning lights. No alarming notifications. Just slow erosion, year after year. While innovation continues moving forward. While productive companies continue creating value. While new technologies reshape entire industries. While patient investors allow time to work on their behalf. The irony is extraordinary. The very instinct designed to protect us can sometimes become the reason we fall behind. Not because we made terrible decisions, but because we delayed making reasonable ones. And perhaps the greatest financial cost isn't the money we lose. It's the opportunities we never allow ourselves to own. Because opportunity has one resource that no investor can replace. And every year spent waiting for perfect certainty is one less year that time has to work in your favor. That's where everything begins to change. Because once you understand that the greatest hidden risk may not be market volatility, but inactivity itself, you stop asking, "How do I avoid every loss?" And you begin asking, "How do I position myself to participate in long-term growth while managing risk intelligently?" That single question separates defensive thinking from wealth-building thinking. And in the next part of this video, we're going to uncover the invisible tax that quietly drains millions of people's future wealth every single year, even while they believe they're making the safest possible financial decision. If you've made it this far, you've already discovered something most people never do. The greatest threat to your financial future isn't always losing money. Sometimes, it's allowing your money to stand completely still while the world keeps moving. Think about this. Imagine climbing an upward-moving escalator. If you keep walking forward, you rise. If you stop moving, you don't stay where you are. You slowly move backward. The modern economy often works the same way. Prices evolve. Businesses innovate. Technology transforms industries. New opportunities emerge. Meanwhile, money sitting idle may preserve its face value, but over long periods it can lose purchasing power if it doesn't grow at a pace that keeps up with rising costs. This is what many financial experts describe as one of the hidden costs of doing nothing. Not because cash is bad. Cash serves an important purpose. It provides liquidity, emergency security, flexibility, peace of mind. Every financially healthy person should have emergency savings. But problems begin when temporary safety becomes a permanent strategy. Because emergency money and wealth-building money should not always have the same job. One protects your present, the other builds your future. Confusing the two often creates years of missed opportunity. Let's imagine two neighbors. Both start with $50,000. The first neighbor decides to keep nearly everything in cash because volatility feels uncomfortable. Every market headline reinforces the decision. Every temporary downturn feels like proof they made the right choice. Years go by. The account balance changes very little. It feels predictable, comfortable. The second neighbor takes a different approach. Instead of trying to predict every market movement, they gradually invest according to a long-term plan. Some years are exciting. Some years are disappointing. Some months feel stressful. There are periods when their portfolio declines. But instead of reacting emotionally, they continue following a disciplined investment strategy. Fast forward 15 or 20 years. The difference between these two people often isn't intelligence. It isn't income. It isn't luck. It's time. One person allowed compound growth to work. The other allowed fear to interrupt it. Compounding is often described as one of the most powerful forces in long-term investing because returns have the potential to generate additional returns over time. But compounding has an enemy: delay. Every year spent waiting is a year that cannot be recovered. Money can often be replaced. Time cannot. That's why opportunity cost is so important. Opportunity cost isn't a bill you receive in the mail. No bank sends you a statement showing the wealth you could have built. No app sends a notification saying, "Today you missed another year of compound growth." The cost stays invisible, which is exactly why so many people underestimate it. Let's talk about one of the biggest economic shifts in recent years: artificial intelligence, cloud computing, advanced robotics, semiconductors, automation, digital infrastructure. These technologies have transformed businesses across multiple industries. Some companies adapted quickly. Others struggled. Investors who maintained diversified exposure to innovative sectors participated in part of that long-term growth. Those who remained completely on the sidelines often watched these changes from a distance. This doesn't mean every technology investment succeeds. Far from it. Many companies fail. Many trends fade. Many exciting headlines disappear. The lesson isn't to chase every new idea. The lesson is that avoiding all participation guarantees missing every opportunity. Successful investors understand something subtle. You don't need to own every winner. You simply need to participate consistently enough that long-term innovation has a chance to work in your favor. That mindset changes everything. Because now you're no longer asking, which investment will make me rich overnight? You're asking, how can I consistently own productive assets over decades? That's a completely different conversation. Now let's challenge one of the biggest myths in personal finance: the idea of risk-free investing. People often say, "I just want something completely safe." It's understandable. Everyone wants security. But true financial safety is more complex than avoiding volatility. Every financial decision involves trade-offs. Holding cash carries inflation risk. Owning bonds carries interest rate risk. Owning stocks involves market risk. Owning real estate comes with property and liquidity risks. Starting a business involves entrepreneurial risk. Even doing absolutely nothing carries opportunity risk. In other words, risk never disappears. It only changes form. The question isn't, how do I eliminate risk? The better question is, which risks are most likely to reward me over the long run? That's a question wealthy investors ask repeatedly, because sophisticated investing isn't about avoiding uncertainty. It's about choosing uncertainty intelligently. This brings us to an idea that many experienced investors quietly accept. Volatility is not necessarily the enemy. Permanent loss of purchasing power is. Market prices move, sometimes dramatically, sometimes unpredictably, but volatility by itself doesn't automatically destroy wealth. Emotional decisions often do. Imagine planting an oak tree. Would you dig it up every week just to check if the roots are growing? Of course not. You understand growth takes time. Investing works remarkably similarly. Growth happens beneath the surface long before dramatic results become visible. Patience often looks boring, until one day it looks brilliant. Fear, however, demands immediate action. To whispers, sell now. Wait. Get back in later. The problem is that nobody consistently knows when later is. History shows that some of the strongest market recoveries have occurred shortly after periods of intense uncertainty. Missing even a handful of strong recovery periods can significantly reduce long-term investment returns. That's why consistency often beats perfect timing. The market doesn't reward perfection. It often rewards discipline. Discipline means continuing to invest when headlines are optimistic, and continuing when headlines are frightening. Because headlines are designed to capture attention. Your financial plan is designed to build freedom. Those are not the same objective. When you begin separating entertainment from investing, emotion from evidence, short-term noise from long-term progress, your entire relationship with money changes. You stop seeing temporary declines as proof that something is broken. Instead, you begin seeing volatility as part of the admission price for long-term growth. Not something to fear, but something to understand. And once that shift happens, you're finally ready for the next level. Because the world's most successful wealth builders don't simply tolerate risk. They structure it differently. They don't bet everything. They don't chase every trend. They look for situations where the downside is limited, but the upside has room to grow far beyond the initial investment. That principle has quietly built fortunes across generations. And in the next chapter, we'll explore exactly how high-net-worth investors think about asymmetric opportunities, why diversification is a strategic advantage rather than a compromise, and how you can begin developing the same long-term mindset without trying to predict the future. Now we've arrived at the question that separates ordinary investors from exceptional ones. If risk can never be eliminated, how do successful people continue building wealth while everyone else remains afraid? The answer isn't that they're fearless. It's that they understand something most people never learn. They don't try to predict the future with perfect accuracy. They prepare for multiple possible futures. Think about the world's most successful entrepreneurs, business owners, and long-term investors. Very few of them built wealth by making one perfect decision. Instead, they made many thoughtful decisions over time. Some worked, some didn't. But the winners often grew large enough to outweigh the setbacks. This is called asymmetric thinking. Imagine risking $1 on an opportunity where the maximum loss is limited, but the potential upside could be many times greater. You won't win every time. No one does. But over a lifetime of disciplined decisions, a handful of exceptional outcomes can have an extraordinary impact. This principle appears throughout business, investing, and innovation. A company launches 10 new products. Most perform reasonably. A few fail. One becomes a global success. A venture capital firm funds dozens of startups. Many never become household names. A small number generate outsized returns. A diversified long-term investor owns hundreds of businesses through broad market funds. Most companies grow steadily. Some struggle. A few become industry leaders that drive a significant share of overall market growth. The lesson isn't to search for perfection. It's to create a system where success doesn't depend on perfection. That's one of the biggest mindset shifts in wealth building. Average investors often ask, how can I avoid every mistake? Successful investors ask, how can I make sure one great decision can outweigh several small mistakes? That's a completely different way of thinking. Now look around the world today. Entire industries are being reshaped by artificial intelligence. Healthcare is becoming more data-driven. Energy systems continue evolving. Automation is changing manufacturing. Cybersecurity has become increasingly important. Digital infrastructure keeps expanding. No one knows exactly which companies will dominate 10 years from now. But history has consistently shown that innovation continues moving forward. The companies may change. The technologies may evolve. The leaders may rotate. But human progress rarely stands still. That's why disciplined investors focus less on predicting headlines and more on participating in long-term economic growth. Participation. That's the key word. Not prediction. Not perfection. Participation. Because every decade introduces opportunities that seemed impossible just a few years earlier. Think back 20 years. Would most people have predicted smartphones becoming essential to daily life? Streaming replacing physical media? Cloud computing transforming businesses? Artificial intelligence assisting millions of professionals every day? Probably not. The future always surprises us. That's why trying to forecast every breakthrough is often less effective than building a resilient portfolio that can adapt as the world changes. This brings us to one of the biggest misconceptions about diversification. Some people believe diversification limits success. In reality, diversification often protects your ability to stay invested long enough for success to happen. If one investment disappoints, another may exceed expectations. If one industry slows down, another may accelerate. Diversification isn't about avoiding growth. It's about reducing the impact of being wrong. And since no investor is right all the time, that matters. Now let's bring everything together. What does a practical wealth-building framework actually look like? Not one based on hype. Not one based on fear. But one based on discipline. First, create a financial foundation before pursuing growth. An emergency fund exists for stability. It gives you flexibility during unexpected events. When your foundation is strong, you're less likely to make emotional decisions during periods of market uncertainty. Second, invest consistently instead of trying to perfectly time every market movement. Whether markets are optimistic or pessimistic, consistency removes much of the emotion from the process. Over long periods, discipline often matters more than prediction. Build diversification intentionally. Broad exposure across sectors, industries, and asset types can help reduce concentration risk while still allowing participation in long-term economic growth. Review your portfolio periodically rather than reacting daily. Many investors spend more time watching prices than evaluating progress toward their long-term goals. Constant monitoring often increases stress without improving decisions. Sometimes the smartest move is simply allowing time to work. Continue learning. Financial markets evolve. Technology evolves. Tax laws change. Economic conditions shift. The most valuable investment may be the one you make in your own financial education. Knowledge compounds just like capital. Every book, every thoughtful conversation, every lesson, every mistake analyzed honestly. Each one strengthens future decisions. And finally, redefine what risk actually means. Risk isn't seeing your portfolio fluctuate during a difficult month. Risk is reaching retirement and discovering your money never had the opportunity to grow enough to support the life you imagined. Risk is spending decades protecting yesterday's dollars while tomorrow quietly becomes more expensive. Risk is allowing fear to make every important financial decision on your behalf. Because fear has an interesting habit. It never disappears completely. Even experienced investors feel uncertainty. Even successful entrepreneurs experience doubt. Even seasoned professionals question their decisions from time to time. Confidence isn't the absence of fear. Confidence is building a thoughtful system that continues working even when emotions become loud. That's what long-term wealth is really built on. Not excitement. Not headlines, not shortcuts, systems, habits, patience, consistency, perspective. Remember the mountain path we talked about at the beginning of this video? Most people never climb it because they're too busy searching for a completely safe route. But the completely safe route doesn't exist. Every meaningful goal requires uncertainty. Every worthwhile journey includes temporary setbacks. Every successful investor experiences periods of discomfort. The difference is that they understand discomfort isn't always danger. Sometimes, it's simply the price of progress. And perhaps that's the greatest lesson of all. The goal isn't to eliminate fear. The goal is to prevent fear from making your decisions. Because the future doesn't belong to the people who always feel certain. It belongs to the people who continue making thoughtful decisions even when certainty is impossible. If this video changed the way you think about money, investing, and opportunity, then you've already taken the first step toward becoming a better long-term investor. Here at Wealth Hike, we believe real wealth isn't built through luck or shortcuts. It's built through knowledge, discipline, and the courage to think differently. Every week, we explore the psychology of money, timeless wealth-building principles, financial habits, and the mindset that helps ordinary people make extraordinary long-term decisions. So if you're ready to stop letting fear control your financial future and start building a smarter relationship with money, make sure you're part of the Wealth Hike community. Because your financial journey doesn't change overnight. It changes one better decision at a time. Thank you for watching. And remember, the biggest investment you'll ever make isn't in the market. It's in the mindset that decides whether you'll enter it at all. Until next time, keep climbing. This is Wealth Hike.